Hello and welcome to the Monday Futures Market Outlook for April 15th, 2013. This is Patrick Sresna. As always, we start off with a chart of the U.S. dollar index, and we have continued to see a little bit of sideways consolidation in the dollar that has certainly been weakening off of its highs. We remain optimistic that the U.S. dollar will remain in bullish trend. We do believe there was room for the U.S. dollar to even weaken down to the 81.50 level through a retracement but would simply represent a buying opportunity. With the euro already beginning to start to weaken, and we now see substantial turns in the Canadian and Aussie and New Zealand dollars, there is now room that the U.S. dollar may actually begin even higher from these levels. So we remain optimistic the U.S. dollar and look at that as a holding. Next here, I want to take a look at the euro, and the euro has had a substantial bounce off of its Cyprus lows around the 128, 127 levels on the downside. We've now seen the euro taper up to the top end of the range, and it looks as to be failing at these zones. If we have a euro that rolls over off of this zone, a new round of selling in the euro is likely to occur, and there's room for that euro to deteriorate and weaken all the way back down to the lows, and even potentially break to a lower low. We remain bearish the euro while there is room for a rally up to that 32.50 focal point up above. We will be watching to see where and how high it goes, but the risk reward of owning the euro is pretty poor. Next here, I want to take a look at the 30-year Treasury bond, and we remain bullish the bond and continue to look for further upside. Bonds tend to represent a risk-on, risk-off trade, and we've seen Treasury bonds continuing to respond positively during a period where the stock market and commodities have continued to weaken. And so we're in an environment right here where we do fully expect Treasury bonds to continue to move to the top end of this range and remain bullish. The one thing is, as we approach those overhead resistance levels, it will take a little bit of work for that bond to prove that it wants to make a break, but so we want to respect any short-term strength back up to those previous highs, but remain optimistic for further upside. Next year, I want to take a look at copper futures, and copper is actually making a critical break here. We were looking for those 2012 lows that came from June and July of last year to act as initial support, but with the aggressive selling we've seen in the gold market and oil markets, copper could not help but to actually begin a new wave of selling. This is a critical break. If we don't see an immediate reversal on the upside of copper from this low, which it still could reverse, but if it doesn't, it does open the window for a drop all the way down to $3 on the downside of copper, and so we want to be careful here. That is, if another leg lower is still getting underway, we don't want to be exposed to copper with any immediate upside potential. Next year, we're going to take a look at crude oil. Crude has had a substantial reversal off the top end of the range, and now today finds itself down about $3 this morning. This selling is now really intensifying, but we are approaching some critical supports. The one thing is that other commodities did not find support at those types of lows, so we're going to be watching whether or not crude can actually hold here. But if we see continued selling in the commodity complex, particularly if it's being led by a strong U.S. dollar, then crude oil may still have further weakness, and we don't want to rush to be looking for a bottom here yet. Let's watch to see whether that support around the 87 starts to hold, about $1.50 lower from where we are, but we're going to be very, very cautious moving into that support. Next year, I want to take a look at gold, and gold has actually had the bottom drop out in what is now a bloodbath drop down to the 1345 level on the downside. This is obviously being driven by news that Cyprus is being forced to sell gold reserves out in the open markets, which is now causing this panic selling on the downside. There is the support coming in at 1300, but really at this stage when a commodity is free falling like this, it's just a matter of letting the drop first happen and then seeing where the dust settles and where the reversal goes. It's probably better to be late on a bounce than to trying to catch it too aggressively or on the selling. If you are trying to catch it, utilizing options as a mechanism of protecting downside risk is a worthwhile exercise. So when we get to the S&P 500, we adjust that upside focal point to 1580 on the upside. Really at this stage we did see a pop higher that was driven by initial remarks from the Federal Reserve, but very quickly we find ourselves already selling off those highs. We still have not changed our tune, even though the market did this little short squeeze fake out to the upside to knock out any short-term short sellers. Really at this stage the market is in a position to potentially weaken here. And we remain adamant that a market correction that could go as deep as 1450 has been long overdue. If it isn't that strong of a sell-off, it might stop at 1480 or 1500. But we don't believe that it's worth being in the market until it represents a proper pullback, so where we can actually call a good buy on dip opportunity for the markets. Just to review our keener market observations, we do believe that the short-term risk reward of the U.S. dollar is average, but we are actually tempted to switch that to a good risk reward at this point. Where bullish U.S. dollars appears to be the trend. Commodities are very much in actually a downtrend. We are going to be changing that long-term trend to down, but the risk reward proposition will slowly favor commodities to being a good risk reward, as we're seeing the selling very much intensifying, which will make a buy low opportunity become attractive at some point here. When we look at bonds, we remain optimistic that bonds will actually continue to do well, even though in the big picture we remain pessimistic about the entire debt structure and eventually the need for U.S. interest rates to rise. At this stage, though, they do represent a risk-on, risk-off trade against the stock market, and while open market operations by the Fed continue to maintain low interest rates, there is room for these bonds to still continue to strengthen. When it comes to the stock markets, the global stock markets have actually already been correcting for well over a month. It's been the U.S. equity markets that have been, with the Nikkei, moving higher over the last few weeks, but really we are seeing the cracks in the armor. The fact that the market has now wiped out the entire rally from last week in one shot is an indication that the sellers have now really come about. Now there will at some point be a short-term rally in the markets, but if it fails to gain any momentum, the selling will begin to very much intensify over the next little while. So be cautious in being long the markets. That was your Monday Futures Market Outlook. Thank you for joining me.